Global markets never sleep. Every second, currencies, economic data, and price charts are in constant motion. But what's the engine driving all this activity? While many forces are at play, interest rates are one of the most powerful. A single decision by a central bank can send massive waves through Forex, stocks, gold, and bonds, all in an instant. So, what exactly are interest rates? Simply put, they are the cost of borrowing money and the reward for saving it. They act like the financial plumbing of the world, controlling how money flows between banks, businesses, and entire economies. When interest rates change, they have a direct impact on major economic factors like inflation, growth, employment, and, of course, the strength of a country's currency. The institutions in charge of this powerful tool are central banks. Their job is to maintain economic stability. They have three main goals: control inflation, keep the financial system stable, and support sustainable economic growth. To achieve this, their primary weapon is adjusting interest rates. A few central banks have a massive global impact. You've probably heard of them: the Federal Reserve in the United States, the European Central Bank, the Bank of England, the Bank of Japan, and the Swiss National Bank. When they speak or act, the entire world listens, and their decisions can cause powerful reactions in currency pairs and markets everywhere. Let's look at what happens when they make a move. First, an interest rate hike. Central banks raise rates when they need to fight rising inflation. Higher rates make borrowing more expensive, which slows down spending and economic activity. This process typically makes the currency stronger while putting pressure on stocks and gold. On the other hand, we have interest rate cuts. Central banks cut rates when the economy is weak and needs a boost. Lower rates make borrowing cheaper, which encourages businesses and consumers to spend and invest more, stimulating growth. This usually weakens the currency but provides support for stocks and other riskier assets. A key concept in the Forex market is the interest rate differential. Think about it. Money naturally flows where it can earn the highest return, or yield. Currencies from countries with higher interest rates tend to attract more global capital, making them stronger. The difference in interest rates between two countries is a major driver of long-term currency trends. But here's a crucial point: markets don't just react to the news, they react to expectations. If a central bank's rate decision is widely expected, the market might not move much because it's already priced in. The biggest moves happen when there's a surprise: either the decision itself is unexpected, or the central bank changes its guidance for the future. In trading, words can often move markets just as much as numbers. This brings us to forward guidance. Central banks don't just announce a rate and walk away. They communicate their future intentions through official statements and press conferences. A hawkish tone signals that higher rates might be coming, while a dovish tone suggests lower rates or easier policy is on the horizon. Learning to interpret this language is an essential skill for any serious trader. Ultimately, the main driver behind all these decisions is inflation. When inflation is rising, central banks are more likely to tighten policy and raise rates. When inflation is falling, they're more likely to ease policy and cut rates. By tracking inflation data, you can get a better sense of what a central bank might do next. Now, a word of caution about trading during these events. Interest rate announcements create extreme volatility. The difference between buying and selling prices, or spreads, can widen dramatically, and sharp, misleading price spikes are common. Many experienced traders prefer to wait for the dust to settle and focus on solid risk management rather than trying to chase the initial chaotic moves. To wrap it all up, interest rates are the backbone of the financial markets. They are a fundamental force shaping the direction of currencies, stocks, bonds, and commodities. Understanding how central bank policy works gives you a powerful, high-level perspective on why markets move the way they do. Always remember, price moves first, and the reason often follows. And more often than not, that reason is tied to interest rates. Thanks for watching. If you found this explanation helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss our next video. See you in the next one.